Welcome back to the deep dive. We're here again to really cut through the noise on these tricky financial concepts.
Absolutely. Ready to jump in?
Great. So today we're tackling something that sounds simple, but trust me, has layers. It's called the tax benefit rule.
Ah, yes, a classic. Seems straightforward, but the nuance is where it gets interesting.
Exactly. And that's our mission today, to really unpack this rule. It's, fundamental if you're dealing with taxes, whether that's for personal stuff, studying for exams, or just being curious.
Right. It can feel a bit confusing at first, but there's a solid logic to it once you break it down.
Okay, but before we properly dive in, just a quick reminder for everyone listening. This deep dive draws directly from the excellent materials over at Farhat Lectures.
That's right.
All the content, the examples we'll use, the explanations, and it all comes from the comprehensive accounting resources you can find at farhatlectures.com.
Yeah, great stuff over there.
So, if you're an accounting student prepping for the CPA exam, or even a seasoned professional wanting a refresher, definitely check out the website. They've got more practice questions, video lectures, loads of support to really hammer home what we talk about today.
Good call.
And a big thank you to Professor Farhat for making this material available to us.
Definitely. Okay, shall we get into it?
Let's do it. So, the tax benefit rule, the basic idea, right? You take a deduction one year, let's say an expense, and it lowers your taxable income.
Standard stuff.
Then maybe next year or the year after, you get reimbursed for that exact same expense.
That
The general rule kicks in. That reimbursement money you get back, it usually counts as gross income in the year you receive it.
makes sense on the surface. You got a tax break before, now you're getting the cash back, so you should probably pay tax on it. Seems fair.
But here's where it gets interesting, like you said.
Exactly. What's fascinating, and really the core of the rule, is the big caveat. The amount of that reimbursement you actually have to report as income, it's limited.
Limited how?
It can only be as much as the tax advantage you truly got from that original deduction. It's not necessarily the full reimbursement amount. It's about how much that first deduction actually helped you on your tax return. That's the crucial part.
Okay, let me make sure I'm tracking this. So the income you have to report in the reimbursement year, it can't be more than the actual specific benefit you got from deducting it in the first place.
Precisely. That's the key. It stops you from being taxed on money you didn't actually get a tax break for initially. Keeps things, fair.
Right. Okay, theory is one thing. Let's make this concrete. We need an example. How about Ted, our single taxpayer?
Perfect. Let's look at TED in year X1. So for single filers that year, the standard deduction was, say, $30,000.
Got it. 30K standard.
Now, Ted tallied up his itemized deductions. He had $27,000 in various things, plus he paid $5,000 in state income tax.
Okay, so $27,000 plus $5,000. That's $32,000 total itemized.
Correct. And since $32,000 is more than the $30,000 standard deduction, Ted, quite logically, chose to itemize. It gave him a bigger deduction, reduced his taxable income more.
Makes sense. He took the bigger number. But, okay, following our rule, what was his actual tax benefit here? How much did itemizing really save him beyond just taking the standard?
This is the critical question. Yes, he deducted $32,000, but he always had the option of that $30,000 standard deduction. So the extra benefit, the advantage he gained specifically from itemizing those state taxes and other things.
It's the difference.
Exactly. $32,000 minus $30,000 equals $2,000. That $2,000 is the real tax benefit he received from those specific itemized deductions that pushed him over the standard amount. That's the number we care about for the rule.
Okay, got it. The benefit is $2,000. So let's fast forward. Year X2 comes around.
Yeah.
And Ted gets a state tax refund check in the mail for $3,000. He overpaid in year X1. Now, the big question is that whole $3,000 taxable income for Ted in year X2.
And the answer, applying our rule, is no. Only $2,000 of that $3,000 refund is taxable.
Because that was his actual benefit.
Precisely. His real tax advantage in year X1 was only $2,000. So the rule says you only include up to the amount of the benefit, the extra $1,000 of the refund. He essentially didn't get a tax benefit for that portion in year X1 anyway, because the standard deduction covered the first $30. So it's not taxed when he gets it back.
That clicks. Okay, quick variation then. What if Ted's refund was smaller? Let's say only $750 came back.
Great question. In that scenario, none of the $750 would be included in his taxable income in year X2.
Why not?
Because the refund amount, $750, is less than the $2,000 tax benefit he actually received in year X1. Since the recovery is below the benefit threshold, there's nothing to tax. The rule protects him there too.
Very clear. Okay, let's switch gears a bit. Move from personal taxes to a business. Blue Office Store, it's a sole proprietorship, uses accrual accounting. This should add another layer, right?
Yeah.
Especially thinking about things like bad debt.
Oh, yeah, this is where it can get quite interesting. So, Blue Office Store, accrual basis. In year X1, they make credit sales of $10,000.
Okay, so under accrual, that $10 K is revenue right away in year X1. They pay tax on it then.
Correct. Then, year X2 rolls around. One customer, let's call him Tony, just can't pay his $10,000 bill. Blue gives up trying to collect. So Blue Office Store claims a $10,000 deduction for bad debt expense in year X2.
Which reduces their taxable income for year X2 by $10,000. They got the tax benefit.
Exactly. But then, plot twist. In year X3, Tony hits the lottery. And being your honest guy, he comes back and pays Blue Office Store the full $10,000 he owed.
Wow. Okay, so Blue gets the $10,000 back in year X3. Is that $10,000 taxable income for them?
Yes. In this case, the full $10,000 repayment is taxable income in year X3.
Why the whole amount this time?
Because they took the full $10,000 deduction back in year X2, they receive the entire tax benefit associated with that $10,000 loss. So when they recover the full amount, the rule says the full recovery is taxable because the benefit matched the deduction.
It's full deduction, full benefit, so
Yeah.
full recovery is taxed. Makes sense.
Now, here's where it connects to something we touched on, tax rates changing over time. This can really matter.
Ah, right. How so here?
Well, imagine in year X1, Blue's tax rate was, say, 35% on that initial $10,000 income. They paid $3,500 in tax.
Okay.
Then in year X2, maybe tax rates were lower, say 20%. Their $10,000 bad debt deduction saved them $2,000 in taxes.
Okay.
10K, 20%.
Right, a $2,000 saving.
But then in year X3, when Tony pays them back, maybe the rate is back up to 35%. Now they have to pay $3,500 tax, 10K, 35% on that recovered income.
Oh, interesting. So over the 3 years, they paid $3,500, saved $2,000, then paid $3,500 again. The changing rates actually worked against them overall in this specific case.
Exactly. It highlights how the tax benefit rule itself is about matching the recovery to the benefit, but the value of that benefit and the cost of the recovery can swing quite a bit based on fluctuating marginal tax rates year to year. It adds complexity to planning.
That's a really important point. Tax planning isn't just a snapshot. Okay, let's bring in Sarah. She's a cash basis taxpayer dealing with state income tax refunds again, but let's focus on those rate changes.
Sounds good. So Sarah, cash basis. In year X2, she paid state income taxes and claimed an itemized deduction for them, let's say $2,100.
Okay.
After considering all her other deductions, her total itemized deductions ended up being $900 more than the standard deduction she could have taken.
Ah, so her actual benefit, like with Ted, was that difference, the $900?
Precisely. That $900 was her real tax advantage from itemizing those state taxes. Now, let's say her marginal tax rate in year X2 was 12%.
So that $900 benefit saved her $108 in taxes, 912%.
Correct. $108 saved in year X2.
Okay, then year X3 arrives, and Sarah gets a state income tax refund of $1,500. So applying the rule, how much of that is taxable?
Just the $900. That was the amount of the benefit she actually received from the deduction back in year X2. The other $600 of the refund isn't taxed.
Right, the benefit amount.
But now let's look at the tax rates again. In year X3, suppose Sarah's income is higher, and her marginal tax rate has jumped to 35%.
Oh, big jump.
Yeah. So that $900 of taxable income from the refund now gets taxed at 35%. That means she owes $315 in tax on it. $900, 35%.
So wait, she saved $108 in year X2, but now has to pay $315 in year X3 on that same underlying amount just because the rate changed.
Exactly. She's actually worse off by $215 paid minus $108 saved just due to the timing and the rate shift. It really underscores how these things interact. The rule itself is logical, but the financial outcome can vary wildly.
Wow. Okay, that really drives home the point about year-to-year planning. Let's tackle one more case, Sue. She had a bike accident, medical expenses, and you mentioned there's a critical twist here.
Yes, this one is super important because it involves another limitation rule interacting with the tax benefit rule. So Sue has this bike accident in year X2, racks up $8,000 in medical bills. She itemizes her deductions. But there's a rule for medical expenses. You could only deduct the amount that exceeds 7.5% of your adjusted gross income, your AGI. It's a floor.
Right, the AGI threshold. So not all $8,000 is automatically deductible.
Correct. Let's say, just for example, that 7.5% of Sue's AGI was $5,000. That means the first $5,000 of her medical expenses aren't deductible, only the amount above that floor is.
So $8,000 total expenses minus the $5,000 floor means only $3,000 was actually deductible.
Exactly. That $3,000 is the only part that actually reduced her taxable income. That was her tax benefit. Let's say her marginal rate in year X2 was 22%.
Okay, so the $3,000 benefit saved her $660 in taxes. 3,000 at 22%.
Got it. $660 saved.
Now for the twist. In year X3, Sue successfully sues the person who caused the accident. She gets a settlement or reimbursement for the full $8,000 of her medical costs.
Okay.
She paid $8K, only got a tax benefit for $3K of it, and now gets $8K back. Applying the tax benefit rule,
Right.
how much of that $8,000 reimbursement is taxable income for Sue in year X3?
Only $3,000.
Just the $3,000.
Yes, only the $3,000. Because that is the exact amount she previously deducted and actually benefited from in year X2. That's the tax benefit rule doing its precise work.
Okay, I think I see. But then what happens to the other $5,000 of the reimbursement? She got $8,000 back. We're only taxing $3,000. Why isn't the rest taxed under this rule? This is where I think people might get confused.
And that is the critical twist. It's crucial to understand why that other $5,000 isn't taxed. It has nothing to do with the tax benefit rule for the prior deduction.
Huh.
That remaining $5,000 is legally considered compensation for her physical injuries.
Ah, okay. A different category of income entirely.
Exactly. And under U.S. tax law, money received as compensation for physical injuries or sickness is generally not considered taxable income. It's excluded. So the tax benefit rule correctly handles the $3,000 tied to the prior tax deduction benefit. The other $5,000 is handled by a completely different rule related to injury compensation.
So the nature of the payment matters hugely. It's not just about getting money back for an expense.
Precisely. The tax benefit rule is laser-focused only on recovering amounts that previously gave you a specific tax deduction benefit. The rest of the payment is analyzed separately based on what it represents.
That's a fantastic clarification. Really shows the interaction between different tax principles.
And just quickly, let's look at the tax rates for Sue. Her rate dropped from 22% in X2 to 12% in X3. So the $3,000 she has to include in income in X3 is taxed at 12%, costing her $360.
So she saved $660 in X2, paid $360 in X3.
Meaning she actually came out ahead by $300 overall, $360, purely because of the tax rate change in her favor this time.
Wow. So it can cut both ways.
Definitely.
Okay, so stepping back and looking at all these examples, the core lesson really seems to be the tax benefit rule isn't just got money back, pay tax. It's did you benefit from deducting this before?
That's the heart of it.
If you didn't get a tax advantage for a portion of an expense, the system generally doesn't turn around and tax you when you get reimbursed for that specific portion later. It's trying to be consistent.
Exactly. It's about fairness and preventing, taxing something twice or taxing something that never gave you a break in the first place. If we connect this to the bigger picture, it really emphasizes how crucial it is to understand the details of your deductions. Not just the what, but the how much benefit did I actually get, especially when you look across different years and see how rates can change.
Right. It makes tax planning feel much more dynamic, less static.
Absolutely. It's an ongoing process. You need to see how these pieces fit together over time.
This deep dive really peels back the layers, doesn't it? Shows how a rule that seems simple on the surface has all this built-in nuance, aiming for fairness.
That's the goal anyway.
So for everyone listening, what does this all mean for you? Maybe take a second to think back. Have you ever gotten a state tax refund after itemizing? Or maybe a reimbursement for something like medical costs, or even a business expense you wrote off?
Yeah, thinking about it through this tax benefit rule lens can be a really good exercise. See if it clicks differently now.
Definitely. And maybe a final thought to leave you with?
Well, I think it's just that even things that seem small, a little refund here, a deduction there, can have consequences down the line, especially with changing tax rates. Really understanding these kinds of nuances like the tax benefit rule, it just empowers you.
How so?
It helps you make smarter financial decisions, maybe anticipate things better, and just feel more confident navigating the whole tax system, which, let's face it, can be pretty intimidating. It's about gaining that deeper understanding.
Couldn't agree more. Well, thank you for joining us on this deep dive into the often misunderstood tax benefit rule. We hope you feel a bit more clued in.
Hope it was helpful.
Absolutely. Until next time, keep learning, keep asking questions, and keep diving depth.